Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about indications of a bottom in the stock market, reasons to do a Roth conversion when the market is down, and the challenge of trading stock options. But before we begin, as a reminder, this financial education presentation should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. The stock market rallied late Friday, but last week closed out down and marked 7 straight weeks of selling. Is the stock market bottoming?
Hey, good morning, Allison, and good morning, everybody else. Obviously, you can see there's some changes in the works here at Ankerstar Wealth. So we have a new background, we have a new upfront square, if you will, and some changes on the website. So thank you for your feedback across the board. We try to incorporate most, but obviously not all recommendations. But please keep them coming, especially now that we have a new format. Go ahead and let us know how we can make that a little bit better. So thank you, Austin, for that question. Is the stock market bottom in? Wouldn't we all like to know? But that's what I do get paid to make that judgment call. And against a judgment call, no crystal ball here. But certainly I think so. When you look at where we are with the futures, basically even, right? They were red this morning. They were all green here a few minutes ago. We'll see how we open in a little over half an hour from now. But, when you really look at the ratios and the history of it, you can make a prediction, right? So instead of showing you a chart this time, I want to talk some kind of mathematical philosophy, if you will, or mathematic philosophy. So the Dow Jones last week, even though we had that big move up Friday, the Dow Jones finished down for the week. So did the NASDAQ, so did the S&P 500. So for the Dow, that was 7 straight weeks of selling. For the NASDAQ and the S&P 500, it was 6 straight weeks. So there is math behind this from a risk reward perspective. And that's what I want to talk about briefly this morning, which is different from casino math. So a lot of people will, look at roulette, for example, and say, well, if it's, using the Dow being down 7 weeks. So if it's red on a roulette table for 7 spins in a row, that must mean that you're more inclined to have black come up on the spin this next time, right? And obviously that's a fallacy. No, the odds are still, just under 50-50 because there's 1 or 2 green squares, depending on where you play. But the math changes significantly. The risk reward changes when a stock market drops. When markets drop, the individual securities on that exchange get cheaper. So therefore, when you think of, say you started with $100 and the market drops 25%. So you would so that's, your account's now at $75. But if the market were ever to get back to even, which, it always has gotten back to even, so I don't know why this would be any different. When the market gets back to even, you'd need a gain of 25% to get back to 100. Well, even though the market dropped 25% to get to that $75, to get back to 100, that's an increase of 33%. Okay, so the math changes a little bit as things get cheaper. So even though your account is down, any new dollars that you put to work at this level, when the account recovers, your previous dollars are made whole from back to where they were, and the new dollars put in faced a 33% gain at that point. So that's kind of the power of flipping the mentality of it's time to buy when the market's down, it's time to sell when the market's down, which is what your emotions want you to do, versus the math, which supports you buying here, because when it gets back to even, that's a 33% gain. If it happens in the next 6 months, which actually I don't think we'll get all the way to new highs this year, but say it happens in the next 2 years, 2 years from today. In that case, that would be a 16.5% annualized return, which is pretty darn good, right? So you can't do anything about the current dollars that are invested, but certainly any new money put to work, the risk reward is now changed, right? So the math I was using with some folks the other day was, can I guarantee the bottom's in? No, but probably, every indicator out there says the bottom's in, but you don't know, no crystal ball. But even if you say, okay, I think the bottom's in, but maybe the stock market could fall another 10%, and it could. So you have 10% risk to the downside, but you have 33% to the upside, because that's where, the market will get back to even eventually. So therefore that's 3.3 to 1 ratio of really reward to risk instead of risk reward, which is what you're looking for. Right. So that's why it's so tough sometimes to buy at the top, because the ratios are out of whack. But once the market sells off, it's really easy to make the buy call here. So some folks have asked about that recently. So to summarize there, Allison, long answer to a tough question, right? Is the stock market in? I certainly think so. Every new dollar that's flowing in, I'm putting to work at these levels.
Next, Roth conversions offer the opportunity to pass taxes in the current year to avoid paying taxes on that money ever again. Should people consider Roth conversions now?
Okay, so Roth conversions can be tricky, and there's a lot of philosophy that goes with these. So like Allison said, you can pay taxes on your IRA money now and change it over to Roth, and it's never taxed again. So is that a smart move? I'm not really going to get into the whole philosophy of it. And obviously every person's situation is different. So mathematically, it's almost always the right move. I will say that. There can be times where it's not the right move, especially if you're going to have a break in income down the road where you're taking a gap year or a gap decade or whatever, where you can spread this thing out to avoid the taxes. That's not what we're talking about here. What we're talking about specifically is when the market is down. And it's interesting. I got totally called out by a CPA, which I had to literally crush in front of his clients, which I don't want to do, but you have to take the fight when it comes to you, right? So, the CPA's point was, I can't believe you were doing Roth conversions in the middle of COVID. I'm like, well, when the heck else would you do them, right? So, and then I had to go into what I'm about to talk to you about. So when the market is down, so when you convert a Roth, it is you convert the dollars, right? So you have to sell, convert, and then you can rebuy those same securities. They're in IRAs, so there's no taxable event there. From the buying and selling of the securities, whether they have capital gains, losses, that sort of thing. The taxable event is the total dollar amount. So if you have $1 million IRA, good problem, right? And you convert it to a Roth, you would have $1 million tax bill. But if your $1 million Roth IRA just sold off 25%, now you can convert $750,000, move that over to Roth, only pay taxes on the $750,000. And then when the market recovers back to $1 million, you ended up paying taxes on a smaller amount. So if you're thinking of a Roth conversion, not trying to talk you into it, but if you're thinking of a Roth conversion, or you're on a Roth conversion plan, like you do $100K a year for a large IRA, now's the time. You want to do it when stocks are down, right? Because they're artificially oversold, in my opinion. But do it when it's down, because the amount is smaller, and that's the amount you're getting taxed on. So it is literally a no-brainer if you're already convinced that a Roth conversion is right for you. So that may have been a lot of math for folks and a lot to think about. If you want to discuss your personal situation, you'll have to reach out individually. But to summarize, you want to do Roth conversions when the market is down, because you will save yourself in taxes.
Last, trading stock options seem fun and easy, but in reality, it is extremely difficult. Can I get your take on stock options trading?
Yeah, this article is from Wall Street Journal yesterday, and it's kind of a follow-on article from a Bloomberg article, which I have pulled up on my phone in front of me. So you can see this one: individual investors step back from options bets. Okay, and I'll get to the other article in a second. But really, a lot of people think, okay, you get crushed in marketing, right? And I won't throw the company's names out there, but you see it on CNBC. You get maybe 100 of these in your email about how easy it is, and you can control the loss if you buy options, right? If you spend $5 on an option, you can only lose $5, but you can make 50 million, right? I mean, that's an extreme example, but yeah, they will kind of oversell you the promise. I mean, the math is true, so they can't be sued because the math is true, right? You cannot lose more than whatever you paid for the option, but it's a lot harder than you think. And when you think of options trading, it's a zero-sum game, right? Where investing is not a zero-sum game. Excuse me there. When you go to invest, the big strong companies continue to grow over time, and the smaller, or not necessarily small, but the bad companies that don't survive get killed off, right? And that's how markets can continue up over time, is because you're constantly weeding out the bad companies, and the others are continuing to grow. Well, in an options trade, there's a winner and a loser, and they're same amounts minus the commission, right? So you still pay commissions on options trades, so the brokerages love them. But you have to, for you to make money, somebody has to lose money. So if you're going to be an options trader and make 100,000 a year doing it, somebody has to lose $100,000 a year in order for you to do that. It's kind of the same math as like poker. So what happens is you have a slim few, maybe even 1 to 2% that is making money consistently, and everybody else has to lose at least a little bit in order for the math to work. So when you think of options traders, well, when JP Morgan has an entire options desk of people that sit there and do this, as their full-time job, and they have to make certain amount of money for the company, otherwise they're going to get fired. They can't lose money, and if they have to make a certain amount to make it worthwhile to pay their own salary and to make the company money. So you're going against some real pros if you're in the option space. So just know that. So the article from Bloomberg, the title was "Mom and Pop Investors Took a $1 billion bath trading options during the pandemic." So you say, okay, pandemic. So basically it rolls back. The data is now in from all of the March 2020, April 2020 options trading. And it's been analyzed, and $1 billion lost across the board. Well, who's soaking that up? Yeah, it's going to be the big trading desks at the big houses that do this full time. So I'm not telling you don't do it. Maybe you have a system that's superior. I generally roll that, but I also don't want to say that it's not possible, because it is. Certainly, if you're disciplined, you can get in there and trade options if you like. So why trade options? Well, certainly these are options buyers, right? Because the math doesn't work if you're a seller. So if you buy options, that's where you limit the downside and you can make unlimited upside. I am an options seller, and I don't do as often as I used to because it takes a ton of time. Certainly, if you sell covered calls, then you have a situation where the seller collects the premium. Well, when it's called a premium, like an insurance premium, they tell you right in the title, you are not getting what you're paying for. You're getting less than what you're paying for, because you're paying a premium, which means you're paying above and beyond what you're getting, right? So you already know when you buy an option that you're paying a premium for the privilege of doing so. So really, two people buy options out there. And first one is the speculator, the gambler, who just wants to take a bunch of little positions and just because it's fun. And then secondly, those that are capital limited, i.e. smaller investors that can't afford an Amazon share at 2,300, but they can afford an Amazon option that you can pay $5 for. So really, you want to be, if you're going to deal in options, you should be a seller of the options and not a buyer of the options. And that puts math in your favor, i.e. you're on the house side of the options there. So to summarize, the data's in. A lot of people lose money if they try to do the options trading stuff. I'm not saying you will. I'm just saying it's a lot harder than you will ever see in marketing material telling you that you can, make 6 figures sitting at home in front of your computer, just playing the market.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.